Hello everybody, welcome once again to this virtual investor event series hosted by NZX. As ever, my name is James Sharp from the origination team here at the Exchange. A quick reminder of the format today. We're going to hear three presentations, each about 15 minutes long. After each of those presentations, we're going to have about 5 minutes for Q&A. So we do encourage those questions to come through. To do so, there is a free text field within that webinar panel that you have on your screen. So just enter your question in there. It's also anonymous. And we do sort of encourage them to be asked sort of as you kind of think of them. You don't need to wait until the end of the presentations. Just gives us a bit of time to collate anything that comes through. Today we're going to talk about fixed interest, which is great. It's a bit of a change to kind of previous routes where we've been focusing on the equity side. So with that in mind, it is a delight to welcome James Cowie, Head of Fixed Interest at Hobson Wealth. Hobson Wealth is a leading Kiwi-owned and operated specialist private wealth advisory group with teams of private wealth advisors in Auckland, Tauranga, Wellington and Christchurch. A very warm welcome to you, James. We'll just wait till your presentation comes up on the screen. Looking forward to listening to this one. I'll be back in a few moments with some questions. Thank you, James. Can see your presentation there. Cheers. Bye-bye.
Great. Thanks, James. Thanks for the nice intro. Look, I think firstly, I'll get the intros out of the way. So I run the fixed income function here at Hobson Wealth as part of the investment team here. My background's in wealth management, asset allocation, managed fixed interest funds, but yeah, my role at Hobson is really full emphasis on fixed income or fixed interest, which is a big part of our business. So if I go to the first slide we've got here, we'll just start off with the basics. So what is a bond? So there's a few common factors we like to talk about when talking about bonds. I guess the common factors are it's typically a loan to an organisation for a fixed length of time, pays a coupon along the way at regular intervals, and pays you the full amount back at maturity. And in common with shares, which the investors on the call will be familiar with, they are divisible and transferable. So investors can buy amounts down to $1,000 or much larger amounts. So I guess what sort of organisations issue bonds? Well, the first example would be governments. So governments issue bonds to the public to finance a good portion of their expenditure. They can rely on taxation for some of it, but they also need to fund it elsewhere. So governments are prolific issuers of bonds, but that also includes organisations like local governments and local authorities, which I think we're going to hear from as well. Companies also need to borrow money, obviously. To varying degrees, they do use the banks. We get that question a lot. Why do companies issue bonds when they can just borrow from the banks? Well, there's a few key advantages for companies issuing bonds to the public. The first is diversification. So if you think about bank relationships, we've only got a few in New Zealand to borrow from. Issuing bonds to the public allows you to diversify your lenders, which is quite nice. Obviously, banks have limits on how much they'll lend any company, regardless of quality. So it is a way for companies to diversify their borrowers, their lenders rather. So bonds are tradable, as we've sort of touched on, just like shares on the NZX. We've got bonds listed on the NZX, or NZDX, I should say. And I've just got a little note here as well about how we quote bond prices too. So you'll see when you log into the NZX, when you go into the NZX website, bonds are quoted in a face value per $100, also a yield. So I mean, we can get into the sort of underlying descriptions of that a bit further on, but effectively, the yield is the equivalent return of what the price would be, giving you the annualized return if you'd held to maturity. As I touched on, here's just some logos of companies that issue bonds into the New Zealand market. A lot of them are familiar to you from sort of buying and selling shares. We also have sort of non-listed entities like Transpower as well. But you can see all these companies have listed bonds on the NZX. One thing I did want to touch on is the value of bonds and how they fluctuate on the market. So obviously, people raise the question, well, if a bond is just an arrangement to pay you a fixed coupon, it should just be a dollar and you get your money in and out based on a dollar. There's an argument to that, but the way we look at it is opportunity cost. So I think the best way to illustrate that is with an example. So if you think about a couple of years ago, if you've had a bond when interest rates were 0, a bond paying 2%, for example, and now interest rates are 5%, well, if you want to sell that bond, that transferable contract into the market to somebody else, they're going to take a view that, well, actually, I can get 5% in the bank now, or I can buy a new bond that pays me 5.5%, 6%. So therefore, if you want to sell this to me, you're going to have to sell it to me as a discount. So the drivers of bond prices in the secondary market is, to a great extent, interest rates going up or down. Obviously, when interest rates go down and you've got an existing bond with a high coupon, that can actually trade at a premium, so you can make money off it, which we'll go into later. But interest rates are a big driver of bond returns over time, as well as obviously your coupon income. The other one is looking at company fundamentals. So obviously, when you have stress in the market at certain times, that has an effect on share prices. It also has an effect on bond prices. So one example was earlier this year, we had the US concerns around the banking system, and the banks started to come under the microscope all around the world. And in that case, you start getting bonds from banks, particularly trading at a lower level than they would otherwise, at a discount. And that's really the market sort of factoring in a greater uncertainty about the organisation's ability to pay back debt when it's due. So general market volatility has an impact on bonds just as it does in equities, although I would note again that this is typically still a lot less volatile than equities are. The value of bonds moves around a lot less than equities. We've got a slide here on the different types of bonds. So typically we think of a mortgage, for example. You buy a house, you go borrow some money, you have your equity in the property, and then the rest of it is debt to the bank in the form of the mortgage. So that's the simplest illustration of how a company would structure themselves too, with bank lending and bond lending, and the equity being the leftover amount for the shareholders. What we have illustrated here is that the companies can also make some variations to that and issue sort of slices in between. So if we look at this illustrative example, right, we've got the equity at the bottom, which is the smaller value relative to the entire company. We've got a lot of senior debt as well, which is first ranking typically, and often secured over individual assets. And then on occasion, companies will issue bonds in between that may rank ahead of the equity, but below the senior debt holders. And this usually provides different returns to investors. So if you've got a bond that has lower repayment priority in the event of financial distress of the company, then it will usually attract a higher return, and vice versa, particularly for senior secured debt of companies that have low debt levels and are deemed quite secure by the market. So that's I guess a really brief overview. We'll turn now to why people would invest in bonds. I think the obvious answer is you get regularly paid income, and if you've got a portfolio that's staggered over a period of time, you'll get repayments of principal staggered too, and the returns are most of the time in excess of what you can get on a rolling term deposit strategy. Income is obviously very important to a lot of investors, and certainly that's something that we find in our business. The ability to construct portfolios that pay out a nice degree of income is very helpful. The other interesting factor though too is when you think about in the context of your whole portfolio. So bonds do have a tendency to perform well when we have tough economic times, and this is because central banks during that period often are cutting interest rates. So if you've got an existing portfolio of bonds issued at higher interest rates, they will often be at a premium as interest rates are cut. So that's quite a nice property, and it means that during those times, often when equity markets have really been struggling, bonds have been producing good returns. So this is illustrated quite nicely on the next slide here. So I think the best example is the financial crisis in 2008, right? So interest rates were quite high going into that. You had these, the big crisis, obviously, central banks cut interest rates to zero, and then obviously existing bonds then traded at a very nice premium. So holders of bonds in 2008 here achieved a plus 15% return, and that would have been against an equity market return of minus 30 or 40. So that is quite a helpful property. The other reason this chart is quite interesting, well, there's a couple of reasons actually. So the first is you can see how stable the return pattern is, as I alluded to on the previous slide. Quite dependable sources of returns, corporate bonds, and this is going back to the mid 1990s. So you can see, we've got sort of returns mostly between 4 and 8% every year, which is nice to have in your portfolio. But of course, your attention is also drawn to these two negative numbers on the far right, which is pretty unusual historically, and it's probably quite interesting to talk to that for a bit. So obviously, we had COVID hitting in 2019. Central banks cut interest rates to zero, and then you must have had during that period the vast majority of corporate debt and government debt being issued at super low interest rates. And that continued for about 18 months. So, the hangover for bond markets from that was interest rates then have risen really rapidly. So these bonds that were issued at super low rates, for corporates, often that was 2-3%. Now you can get corporate bonds for 6-6.5%. The existing bonds in the market get devalued down. So that explains those two losses in 2021 and 2022. Very unusual, but the thing with bonds is, once you reset interest rates to a high level, it produces, better returns going forward. So we should see much better returns from bond markets in the next 2 or 3 years, particularly if we do get unexpected interest rate cuts from the central bank. This next slide is just, again, sort of to talk about bonds in the context of other assets. So what we have is, going to the further right is assets that are sort of more risky, and going upwards is high returning. So you can see there's a straight line relationship between risk and return. So on the far right, we've got things like venture capital and private equity, much more volatile, risky type investments, but can give you much higher returns. You've got the cash on the far left, giving you lower return, obviously very low risk, and then in the middle you've got your different shares and property as well. So bonds sit towards the lower risk end of the spectrum. As you can imagine, they sit further up in the security stack of a company, and that's reflected in the returns they provide. This next slide I just thought I'd put in, we do get questions from clients about, why would I go into bonds versus term deposits? I mean, there's a few important reasons, I think. Bonds are obviously tradable, so you get paid your income on the way along, quarterly, half yearly. Most of the corporate bonds we have in the New Zealand market do pay out quarterly, unlike a term deposit strategy, which you get your interest at the end. You can buy and sell bonds before maturity without losing your interest entitlement, unlike break fees with term deposits. And bonds are usually higher returning compared to term deposits, unless you're going to something like really low risk, like government bonds. If you can hold to maturity, you will accrue the return. Whereas in term deposits, you don't really want to have to break them. So a lot of my role is looking at how to manage bond investments as we go through the economic cycle and look at companies. So with bonds, you've got a slightly different focus from looking at normal shares. So I guess it's a glass half empty view. With bonds, the focus is really on, can the company pay these interest payments on an ongoing basis, and can they repay the principal on maturity? So things like revenue growth are a bit less important. We're not looking for blue sky factors. We just want the irregular interest payments, and we want our money back. Government bonds obviously are considered very low risk, particularly for countries like New Zealand and other developed markets. In fact, they're considered risk-free if they're issued in their own currency. So, for example, New Zealand government can just print New Zealand dollars to cover its debt when they come due. Emerging markets often will issue bonds in foreign currencies like US dollars to lower their borrowing costs, and that's a problem for them if they get into a situation where they can't get hold of US dollars and they may have to default. But for a government a developed market government issuing bonds in its own currency, basically considered risk-free. So that can be an important part of portfolios. It also allows you to go much further out in maturity, because government bonds you can buy up to 30 years, whereas most corporate bonds are between 5 to 7 years. So the other thing we look at closely is sensitivity to interest rate moves, and these are metrics like duration. So if you think about a basic strategy, if you think interest rates are going to unexpectedly rise versus what the market thinks, you want to keep your duration short, your mix of bonds quite short dated, and that means you'll be able to reinvest your maturities when they come up at higher interest rates as they progress. And then the reverse also holds true. So if you think interest rates are going to go down more than the market does, you'll want to lock in those current income levels by buying sort of longer duration bonds where possible. And certainly that's the view we have at the moment at Hobson Wealth. So I'll just go to this last bit. I think that's the main part of the presentation done before we can get to questions. Just a quick little bit on Hobson. So we're an independent wealth manager. We're also an NZX advice and trading participant. So that means we can buy and sell bonds for clients on their own account. We can also advise on bonds together with other assets and the rest of client portfolios. The other thing we do as well is we will act as a manager for new bond issues periodically. So that means we're working with corporate issuers to bring new bond deals to market. And we've done a few of those deals this year. So we've been on a BNZ deal, we've been on a Westpac deal and a Somerset Retirement Village deal as well. And yeah, obviously the usual financial disclaimer, this is not personal advice, general terms. And please speak to a financial advisor if you want any advice on specific securities or your own circumstances. So with that, I'll throw it back to James for any questions that have come through.
Thanks very much, James. Great presentation. Sorry for the confusion at the start. I think I said fixed interest, I meant fixed income. So correction there.
That's all right. There's a lot of jargon. But yeah, I will say, yeah, fixed interest, fixed income, bonds, they're all interchangeable terms. I think the various shops around town have different ways of referring to them, but it's all the same.
Fine, good to know. Excellent. We do have a question that's come through, and it's relating to hybrids. Actually, we've got two questions, both relating to hybrids. So hybrids have bond-like returns with equity-like risk. Would you agree?
Well, it depends, right? So there's a lot of nuance related to the individual structure, and without wanting to speak too much to individual securities, a lot of them are structured with sort of quite attractive backing terms. And the premium offered is quite good in a lot of cases relative to sort of more senior type issues. So I guess that the place to start would be the bank hybrid sort of structures, which are basically senior to your equity, but junior to your bondholders, to your senior bondholders. And they do actually provide, when you think about how well regulated the banks are in New Zealand, we've seen a lot of issues overseas, obviously, with their banking system. The New Zealand banking system is extremely well regulated, and the capital they have to hold makes them much safer than banks elsewhere in the world. So I would argue that in situations like that, my personal view is you're getting quite well paid for that risk. The other thing I would sort of mention right now is, because we've had such a quick rise in interest rates, bond yields generally are quite attractive versus dividend yields for a lot of companies on the market. So if you consider a lot of the property companies, for example, bonds yielding sort of 6.5%, 7% on a cash basis, that's actually pretty good. So that can move around over time. But yeah, look, I think people need to look at their liquidity tolerance, their desires for cash flow, all that sort of thing. We're looking at hybrids, and definitely look very hard at the individual structures behind it and the issuer. But because there are a lot of differences with the hybrids that are issued.
Okay, great stuff. Thank you, James. Probably a second question, perhaps before we move on. I think it's actually, I think this question is, where would you see hybrids on your risk and return chart? There is a what seems like another question. I think that's a separate one. So yeah, where would you see hybrids on your risk and return chart? I think you've just touched on that, but maybe just to recall.
Oh yeah,
Anything.
absolutely. So yeah, so I put bonds as a single slice there. I guess I would put them slightly up and to the right of a normal fixed income senior bond offering. So slightly to the top right of that, but definitely less than your vanilla equity.
Okay, great. Sorry, and there is one final one. In what way are coupon payments taxed? If you're able to talk to tax.
Yes. So once again, we're not tax advisors, but look, at the simplest level, your coupon is taxed at your withholding tax rate, which is similar to your marginal tax rate. So obviously you have charities and things which don't pay any tax on coupons, but yes, they are. The coupons are taxed as you get them at your withholding tax rate.
Okay, great. Thanks, James. That concludes that one. I think that's all the questions. So, James, thanks very much for joining this morning. See you again soon. Great stuff. Thank you.
Thanks a lot. Appreciate it. Cheers.
Cheers, James. Right, moving on to our second presentation and the first of our two debt issuers, or NZX debt issuers, I should say. Warm welcome to Mark Butcher, Chief Executive of the LGFA. LGFA, Local Government Funding Agency, specialises in financing the New Zealand local government sector, primary purpose being to provide more efficient financing costs and diversified financing sources for New Zealand local authorities and council-controlled organisations. I'm conscious I hope I haven't leaned into your introduction too much there, Mark, but I'll hand over to you and I'll be back in a few moments with some questions. Thank you.
Thank you, James, and look, welcome everyone. Hopefully you can see the presentation up in front of you. Just checking, I can't actually see it, but that probably doesn't matter. LGFA, we're the local government funding agency. We're not the Ladies Gaelic Football Association. We've had some confusion in the past over the acronym, but look, we are the largest issuer of bonds in New Zealand after the New Zealand government, and we've got the largest amount of bonds listed on the NZX. So we were established in 2011.
Sorry, Mark. Your cursor's just on. If you can just click once on that where your cursor is, and that should minimise the presentation. That's just this is overlapping a little bit. Can you see it?
No, I can't.
Okay. Just hold fire a second, folks. We've got a background version of the presentation. I think we might switch to that just so you can see it on the screen. I think we'll do it that way. So we'll just go for plan B. If you just bear with us, Mark. Sorry about this. So Anna, if you want to just bring the Mark, if you stop sharing your screen, and we'll share from our side, and we'll have the backup presentation, and we'll cycle through that for you. So we'll just give it a few moments there. Thanks for your patience, folks. This is obviously live, and technology is always is what it is. So I'll just wait for that backup presentation to start, and then we'll get back into Mark's presentation. Thank you. Yep, we're just bringing that up now. Sorry, thanks for your patience, folks. There we go.
Perfect. I can see it. So will you just control the screen for me, will you?
Yep. So just say flick on when you need to.
Okay, let's just flick onto the disclaimer, the next page then. So if you can do that, that's good. Just sort of see that my disclaimer is bigger than James's disclaimer previously. So you can read that later on at your leisure. Just move on to the next page, James, that'd be great. As I sort of said, look, we've been around since 2012, so we're relatively new, but these types of agencies are actually been around now since 1899 in Denmark. With community credit as well. So we were established in late 2011. We've got our own Act of Parliament, the Local Government Borrowing Act, Basically, look, our purpose is to borrow and lend to councils in New Zealand. So objectives are to provide long-dated lending, cheaper lending, and provide access to markets or to debt markets for councils. Just move on to the next slide. That'll be great. To give you some idea about how we're actually sort of structured. So we have 31 shareholders. We're partly owned by the New Zealand government, and then 30 councils have the remaining shareholding. Importantly, in terms of our borrowers, there's 78 councils in New Zealand. We have 77 of those councils are members. The only council who's not a member is the Chatham Islands Council, and they really have a very low level of debt. Importantly, when a council borrows from us, they pledge as security their rates revenue. There's no point being a lender to a council and having security over, say, a swimming pool or a toilet block or something like that. It's very hard then, obviously, to regain your security. So when councils borrow, they offer up rates revenue. We do have a guarantee structure, so we get to a AAA credit rating, partly due to our guarantee structure. We're not guaranteed by the New Zealand government. We're guaranteed by 71 councils. So councils, when they join our GFA, they don't guarantee each other. So Dunedin City Council doesn't guarantee Auckland Council, but what happens is that the councils guarantee our GFA. And that's really important. Why governance is really important in these sorts of structures. You've got to have independent governance. If you think about it, our councils are our shareholders, they're our borrowers, they're our guarantors. So independence of governance is actually really important, because that's to protect the interest of the investors and the guarantors. We also issue bonds under the Financial Markets Conduct Act. We're audited, which is really important as well too, to actually provide that governance oversight. If you just move on to the next page, that will be really good. Slide 5. So there's the membership on the left-hand top side there. As I said, 77 councils. So we've got about 93% market share of all council borrowing comes through our GFA now. We're in fact the largest lender in the country after the 5 major banks, and that's because of the amount of borrowing that actually takes place within the local government sector. So you'll sort of see there in the bottom left-hand side there, since we started in 2012, you've seen a growth in council borrowing over that 11-year period. So you sort of see now that councils are borrowing somewhere between sort of $3 and $4 billion per annum. Really importantly, though, to point out that councils borrow only to fund capex and infrastructure. They're not borrowing to fund for operational reasons at all. They do run a balanced budget, and so what that means is that any borrowing they do is to fund capex. And we've just moved to the next slide on slide 6. A bit slow. So this is just showing who borrows from our GFA. We are a funding conduit to the 77 councils and 3 CCOs. If you look there on the left-hand side, our largest borrower is Auckland. So Auckland's borrowing just under 20% of our lending to councils. We do restrict them to 40% so that the lending book isn't too one-sided. But you have to remember that, you know, Auckland as a region is around about 35% of population in the country, and also GDP as well. Importantly there, our top 10 borrowers are around about 64% of our borrowing, but that's what you'd expect with the high growth councils and the large metro councils as well. And finally on that slide there, you'll sort of see in the top there that councils are relatively long dated borrowers, just over $16 billion of their borrowing, or 97% of our lending is actually on a long-term basis. Councils can borrow from us out to 14 years now, so 2037. So some of them are borrowing to match their longer dated assets. We can just move to the next slide, please, slide 7. So just to give you some feeling about credit ratings. So look, we have credit ratings from 2 credit rating agencies, Standard & Poor's and Fitch. Our credit ratings are the same as the New Zealand government. So we are AAA rated by Standard & Poor's, the same as the government, and we're AA+ rated by Fitch, which again is the same as the New Zealand government. Similar themes amongst 2 credit rating agencies. The underlying credit quality is very strong. We only lend to councils and CCOs. There's also some very close links to the New Zealand government as well too. So under the Fitch methodology, our credit ratings actually equalise to that of the New Zealand government. And S&P note that there will be an extremely high likelihood of support coming from the New Zealand government if we were in a stress situation. But I do repeat, we're not guaranteed by the New Zealand government. And then the other thing is obviously there's always some weaknesses from the rating agency's point of view, and they talk about the fact that we are highly concentrated to our top 10 borrowers, and also capital adequacy as well too. We don't have as much capital as the banks, but that's obviously because we've got a very high quality lending book. If you can just move to slide 8, that'll be really great. I think the next slide. So look, just on the right hand side there, it's just sort of showing you the blue line is the amount of bonds that we have on issue. So you sort of see that back in 2012 we started off with about $835 million of bonds, and then we're now up to just on $18 billion of bonds outstanding. If you look there too, just on those orange bars there, when we first started, the sector was really only borrowing about $1.6 billion a year, but it sort of stepped up in 2019, 2020 to about sort of $2.5 billion. The last 3 years we've sort of seen as CapEx has increased across the country and infrastructure investment has taken off, we've seen sector borrowing at about $3.5 billion. And then you sort of see our projections for the next 3 years is for about sort of $4.2 billion of borrowing by LGFA every year. How we borrow basically is just a couple of points here on the left hand side. How we issue, we basically match New Zealand government bond market, the bond curve where we can. We are a very active issuer. We are actually borrowing every month, so we hold tenders or auctions each month, but then we hold larger syndications twice a year. Importantly, all bonds are listed on the NZX, and I'll talk to that a little bit later on, but we listed all our bonds in 2015 and have been having all our bonds on the NZX since then. If you just move to the next slide, I think there must be slide 9. So these are our bonds on issue. So we have a whole yield curve of bonds of 11 bond maturities stretching from 2024 out to 2037. We tried to have at least $1 billion in each bond line because it's really important to have them as liquid as possible. But we do have a maximum cap of around about $3 billion per line. And then just on the right hand side there, look, there's the yield curves from 2024 out to 2037. The LGFA yield curve for our maturities is in blue. Then the New Zealand government bond yield curve is in orange there. So what you see down the bottom there is that investors who buy LGFA bonds typically get between 0.28% and about 0.7% of a pickup in yield over New Zealand government bonds. And then just the next slide, and James already sort of touched on this, and this just to show you that bonds aren't always boring. So this is the average of each of 11 bonds on maturity, the average yield. So you see when we first started issuing, the average was about 4%. Then obviously with the monetary policy easing and the quantitative easing that occurred in New Zealand in early 2020, 2021, we saw yields fall down to the historic lows. And then when monetary policy has been tightening and quantitative tightening has been occurring, we've seen interest rates move back up in terms of the average of the 11 LGFA bond maturities up to above where we first actually started to borrow back in 2012. Just moving to the next slide, just to give you a quick snapshot, I think, on who owns our GFA bonds. As I said, we are listed on the NZX bonds. Our largest investor group are in blue there. They are our offshore investors. So they hold about 6.4 billion or 37% of our bonds on issue. The second largest group are domestic investors. So they are in grey. They're about 5.4 billion. Or about 31%. So they're a mix of institutional fund managers, the ACCs, the Kiwi Savers of this world, but plus also retail investors as well too. New Zealand banks hold about 4.3 billion or about 25%. And then the Reserve Bank there in green, they hold $1.2 billion of our bonds. So when the Reserve Bank eased monetary policy and did quantitative easing in 2020, 2021, they only purchased New Zealand government bonds and our GFA bonds. So the Reserve Bank has a residual holding of our bonds as well too. Just move on to the next slide, on slide 12, and just talk to you about sustainability very briefly. So sustainability is obviously very important for both equity investors and also debt and issuers at the moment as well in New Zealand. Look, our GFA, we're similar to a bank. We borrow money and we lend it on. So our use of proceeds are basically our loans to our councils. So we're a small organisation. You know, we don't have a large carbon footprint. I think we emit about 50 tonnes of carbon per annum. Where our role is in terms of sustainability is that we can influence our council members to become more sustainable, and that's going to have a much bigger impact. I think the council sector emits between 1 million and 2 million tonnes of carbon per annum. So it really is our job to encourage them to actually look to reduce their carbon footprint. We do that with two lending products. We have a green, social and sustainable loan product where councils can borrow from us, and then we also have a climate action loan product as well too. And so really for us, it's putting a spotlight on the sector, trying to encourage our councils to actually borrow on a more sustainable basis. We do provide them with a discounted borrowing margin if they do take up these two sustainable lending products as well. And what that means is that we can also start issuing our own sustainable financing bonds, of which we've got one currently. So if you just move to the next slide, I'll just talk very quickly about our latest bond that we listed on the NZX in April of this year. And this was on May 2030 sustainable financing bond. So it is slightly different to our 10 other vanilla bonds. So what we've done here is that we've issued $1.1 billion. We've actually allocated the proceeds notionally to a pool of our sustainable loans that we've made to our councils. So about $300 million of our loans to councils are now green, social, sustainable loans. So they are largely green buildings, they are social housing in Christchurch, and also climate change adaptation or flood mitigation. So we've linked to on Te Kina, the new convention centre in Wellington. That's the Whangarei District Council's head office or civic centre. There's the Nainai swimming pool, and then also there's all the mitigation work going on up at the Hutt River as well too. Then finally, our climate action loan. So what happens there, if a council's got a greenhouse gas emission reduction plan in place and it's consistent with net zero by 2050, if it's consistent with them reducing their emissions by a half by 2030, and if it's science aligned based targets, then we will give them a discounted loan margin, provided that they're meeting those emission plan reduction targets as well as they go along. So they're proving quite popular with the larger councils. So you see we've already got 650 million of loans out against that. My final slide is why our bonds listed on the New Zealand Stock Exchange. As I sort of said, look, we are the largest issuer of bonds in New Zealand after the government. It's really important for us to have as widespread investor coverage as possible. You sort of see there on the right-hand side, I think our bonds are doing about $30 million a turnover on the NZX every month. That's about 15%, I think it is, of the turnover on the NZX debt market. In the wholesale market, our bonds also trade, and they're doing about $1 billion a turnover a month, but that's between large banks and offshore investors as well too. But look, we're very pleased with being listed on the NZX. As I said, we made the decision to list in 2015. Importantly, it allowed retail investors at the time to access, I suppose, local authority bonds. Back in the 1980s, 1990s, early 2000s, you could have bought local council bonds, but now you can actually have a much more diversified allocation to the sector by buying LGFA bonds. We also came out of the Capital Markets Development Task Force and of all places the Job Summit in 2008, 2009. So it was very important for us. That was one of the key recommendations, was to grow capital markets in New Zealand by having a vehicle such as LGFA. And then the final reasons are really around offshore investor preference. Offshore investors prefer bonds to be listed on an exchange so that they can see the visibility of pricing, but also it's very important from governance best practice to have independent oversight, to have continuous disclosure obligations to be subject to, like the NZX listing rules as well too. So lots of real reasons for both us as a issuer, but for investors as well too, to actually have bonds listed on the NZX debt markets. So look, I'm happy to pass it back to the moderators, and apologies for the technology problems we had.
No apologies needed from you, Mark. That's we'll have a look at that. So thanks very much for your patience with just the start there, and to those dialed in. We do have a couple of questions for you, Mark. Both actually relate to Auckland. So question one is, Auckland provides 28% of the guarantee, but only makes up 20% of the borrowing. Does that mean Auckland is subsidising the system in some way?
I used to be the treasurer at Auckland Council when Auckland actually joined LGFA. And look, it's a collective vehicle. It's there for the benefit of the sector. You could argue that's the case, but then again, look, these vehicles are going to be around for 100 years, 150 years. We're only looking over a 10-year horizon. One reason why, of course, Christchurch is higher is because, of course, it's had the post-Canterbury earthquake rebuild that occurred, so they've got brand new infrastructure. They will repay that debt over the life of the infrastructure. And then the other larger borrowers relative to their share are the high growth councils, the Hamiltons, the Taurangas, and that as well too. And again, they won't continue to grow forever. And again, they will look to repay back. So yes, on face value, it does look like that Auckland's subsidising the sector, but you know, we can come back again in 50 years' time and we can have a look at the numbers then if you want.
Indeed. Thanks, Mark. And then the second question is with the there's actually three questions. So question two is, Auckland also issues debt directly. What would make them choose a direct issue rather than borrow from the LGFA?
Yeah, it's purely just diversification of funding sources. I think if I put an Auckland Council hat on, they probably borrow about a third through LGFA, a third in their own name domestically, and a third of in their own name offshore as well too. So for them, given the size of their program, they obviously have to have a much greater diversity of funding sources than, say, a smaller council who might only have $15 million to borrow. Auckland's got, you know, I think $7 or $8 billion of debt to manage.
Fantastic, thank you, Mark. And then lastly, with the changes to water infrastructure ownership, do you envisage a structure similar to LGFA for the water entities?
Yeah, so that in the last piece of legislation, the fourth piece of legislation, which has just gone through, they've provided the opportunity for an equivalent vehicle to LGFA to be established. There's been no decision made on that yet, but you know, central government wants to leave as many funding options open to the water services entities going forward. And so it makes sense to have a look at bank funding, have a look at funding in their own name, but also given the success of LGFA to have a look at a collective vehicle as well too. So I think that will play out over the next 6 months, and we'll get a final resolution probably early next year.
Okay, great to hear. All right, Mark, that concludes our questions as well. So thanks once again for joining us this morning. Really great presentation, and see you again soon. Thanks, Mark.
Thank you.
And last but not least, then we turn to our final presentation, and it's a warm welcome to Chris Sutherland, who's Treasurer at Transpower NZ. Transpower have a core purpose, which is to empower the energy future of New Zealand. They provide the infrastructure and market systems that connects electricity generators to major electricity users and distribution networks that deliver electricity to homes and businesses across the country. Good morning to you, Chris. We are just still good morning. I'll wait for you just to put the presentation up, and then hi, Chris, and then we'll get going.
Okay, great. Well, thanks for everyone's time today, and thanks James and the NZX for inviting us onto the presentation today. First off, we have a disclaimer, slightly shorter than the LGFA, but similarly, you should read that at your leisure. It's important information that you should pay attention to. Okay, turning now to the agenda. What we'll cover off today is a company overview of Transpower, a little bit on Transpower's sustainability proposition, a green financing framework that Transpower implemented in 2022, and a little bit on our capital expenditure profile for the coming years as Transpower looks to build the transmission grid to enable more renewable generation and electrification of the economy. Just in terms of Transpower's investment proposition for those people who are thinking about investing in bonds, Transpower is a strong investment grade at AA with Standard & Poor's global ratings. It's a very good rating. A lot of that comes up because of the Crown ownership, which is 100%. And while similar to the LGFA, Transpower is not guaranteed by the New Zealand government, the rating agencies assign a very high likelihood of government support should Transpower be distressed. And of course, given the regulated nature of Transpower's business, that's relatively unlikely that we would get in that particular position. We've got this green financing programmatic certification that we achieved last year. So all of the debt that Transpower issues is now certified green by the Climate Bond Initiative, and the infrastructure that we're investing in with your bond investors' dollars is all around enabling new renewable generation and electrification of process heat and increasing electrification of the EV vehicle fleet in New Zealand, etc., etc. Transpower itself has a prudent financial risk management. I will come on to a little bit on that a little bit later. We're an essential national utility with very high barriers to entry. We're the only transmission network and system operator in New Zealand. Good experienced governance and management team, Crown ownership 100% I mentioned, strong regulatory framework which facilitates stable and predictable cash flows. We have 5-year regulatory control period where our economic regulator, the Commerce Commission, will allow us a maximum allowed revenue, and we're relatively certain about what our revenue will be from year to year from several years out, given that regulation. And then we've got a relatively low counterparty or credit risk and an enforceable requirement to pay from customers who are typically the distribution companies and the generators here in New Zealand and several large direct connect corporates or industrial facilities. They generally have a high credit rating anyway, but if they didn't want to pay or couldn't pay, then essentially those transmission charges get socialised amongst all our other customers under Transpower's regulation. Just a little bit on the company overview then. Transpower's assets, transmission lines and substations run up and down the country. You'll see them from time to time as you drive around the country. Those are those large high voltage alternating current or HVAC transmission lines and towers and substations. We also have some high voltage direct current transmission lines as well that they run between Benmore and the Haywoods, where we transmit electricity with a lot lower losses under the HVDC network than we would under the HVAC network. So essentially operates as kind of an economic asset for New Zealand, transporting the the high generation in the South Island from the hydro lakes through to the majority of the demand, which is in the North Island there. As well as being the owner of all the transmission lines and substations, we're also the operator of the electricity network as a system operator. There's no volume risk on Transpower's revenues. We are simply charging customers for the use of our assets. The actual generation volumes and etc. is all worn by the generators here in New Zealand. We have over $5.5 billion of regulated transmission assets. That's the regulated asset base, and we have about $3 billion worth of debt that we issue into the domestic market and also some offshore markets. Okay, just turning now on Transpower's operating results for the year. The Commerce Commission, as well as being our economic regulator, also regulates Transpower for service standards, and we set certain service standards every year. Mostly those around grid operations and grid availability and system operations targets, as they're called. Normally Transpower is very good and meets all those operation targets, but in the prior year, or the year to June 2023, we did actually miss some because of the Cyclone Gabrielle and some of the outages we had associated with the substations affected by those weather events. Okay, on financial performance targets, as said, very highly rated, AA, and we work hard to maintain those credit ratings, and that's around balance sheet strength that we maintain, and the financial returns that we make from customers set by the Commerce Commission, who's the economic regulator. Just a little bit more lower down in the slide around our Transpower financial metrics that we target. We have no financial covenants in our loan or borrowing documentation, but we do aim for free funds from operation to interest cover of no less than 2.8 times and FFO to debt of no less than 12.5%. And those are relatively consistent with our similarly regulated international transmission peers. That's the likes of National Grid in the UK, or Statnett in Norway, or Fingrid in Finland, and etc. etc. Can I mention that Transpower's very strong focus on sustainability. Transpower has a central role in decarbonisation here in New Zealand. We're connecting new renewable generation up into the transmission network, into the electrical system. We're ensuring that the electrical grid stays fit for purpose and that new connections can be accommodated both on generation and on demand for the increasing amount of EVs in New Zealand's vehicle fleet, plus the electrification of process heat that's occurring in New Zealand at the present point in time. And we're looking to operate a highly renewable and more distributed power system. With the more and more renewables that come onto the electrical system, the harder and harder it comes to balance the supply and demand. And so, of course, the system operator has a key role in ensuring that we can meet that balance on the system. Just in terms of the electrical inquiries or connection inquiries, you see here, given the electrification and the drive for decarbonisation by 2050, there's an increasing amount of renewable electrification or generation being attached up to the transmission grid, and more inquiries all the time. You see from this chart here that those increases in inquiries, some of which are going to translate into new connection inquiries, have been escalating quite dramatically over the last several years. So while we haven't seen a lot of growth in the electrical system over the last 10 years or decade, in the near future, we'll see an increasing amount of electrification and increasing amount of demand and generation on the system. Interesting enough, a lot of the new generation inquiries that Transpower gets nowadays is solar as opposed to wind, so that no doubt the economics of solar versus wind have changed around the last several years, and solar plus batteries is an increasing source of the demand or connection inquiries that Transpower's been getting. Turning now to sustainability, Transpower has 3 challenge areas around climate change. I'll just turn over the slide here. Environmental stewardship and sustainable business, and we have some strategic outcomes and KPIs that we focus on every year. We publish those strategic outcomes and KPIs and focus areas every year, and you'll see at the top of that particular slide there the NZX shares the slide pack with you, that there's a link to the sustainability strategy that Transpower has on our website. So I'll just move on. The green financing framework then. As I said, we certified all of our bonds and all of our borrowings as green bonds under the Climate Bond Initiative, Climate Bond Standard version 3 in May 2022. All of our debt going forward is certified as green, and every year we are producing a green bond report, which is on our website, which really goes through our eligibility, our allocation, the impact that Transpower's green bonds have on decarbonising New Zealand's energy system, and some stuff around adaptation and resilience, which is relatively unique around the certification, but Transpower being an enabling role rather than generation of hydro or wind generation, etc. Adaptation and resilience, and being a good asset manager is certainly important for the Climate Bond Initiative. So those are some other additional requirements I've placed on the Transpower and transmission assets under their Climate Bond Standard taxonomy. Okay, just looking now at our eligibility criteria. The reason why Transpower can issue these green bonds and fit within the Climate Bond Initiative's criteria is that we are enabling a very high percentage of new connection, which is renewable generation or low emissions. And you see from this particular table here that around about 78% of the new renewable connections to the transmission grid over a rolling 5-year period are low emissions. So New Zealand is relatively unique globally, and that a very high proportion of our generation is renewable. Just in terms of the impact a little bit more, which I'll let you read at your leisure, given that we're running a bit short on time. This chart here illustrates the emissions saving from the new renewable generation connected up to the transmission system over the last 5 years, and you'll see that annually that grows as that displaced coal or gas or whatever we are displacing with the wind and solar, as that has an effect of a growing effect year upon year around our avoided carbon emissions. And you can see that those are sitting between something between 2 and 3.5 million tonnes of CO2 emissions over the last 5 years. Just in terms of the growth in installed generation capacity, you can see on this line here, or this chart, the green line illustrates the increasing amount of renewable generation on the electrical system in New Zealand, and a decreasing amount of high emissions, that's coal and gas generation that's that on the New Zealand electrical system. Similarly around generation, you see the same trend, increasing amount of renewables and a decreasing amount of non-renewables or coal and gas. In terms of the eligible green assets alignment to the UN development goals, we're ensuring access to affordable, reliable and sustainable modern electricity or energy for all. We're building a resilient infrastructure. We're taking urgent action to combat climate change and its impacts, and through our sustainability page on our website, you'll be able to read through that. And then again, we're protecting and restoring, promoting a sustainable use of ecosystems, etc. Transpower is quite active in improving the biodiversity and replanting around wetlands, etc., around our substations up and down the country. Here we have just a couple of tables around eligible green assets. We have around about $4.6 billion of eligible green assets and around about $3.2 billion worth of debt, and that debt is applied to the eligible green assets. And so you can see that we still have, under our programmatic certification, a considerable amount of headroom, about 30% of growth in debt to apply against eligible green assets. Just another slide around generation, but we kind of covered over that, so I'll move through these last slides pretty quickly. Electricity demand growth in New Zealand, as I said, been relatively stagnant over the last decade, but of course we're forecasting an increasing amount of demand in generation. That's mostly around the electrification of the vehicle fleet here in New Zealand and process heat electrification, which you can see are forecast to increase quite considerably by 2050 as we increase the or move towards net zero emissions by 2050. Yeah, just in terms of capital expenditure, Transpa has, given all the assets, a large capital expenditure program. We've got a net zero grid pathways program of work that we're undertaking to achieve a net zero grid by 2050. And we have a couple of projects that we've put through to the Commerce Commission for approval at the present point in time, worth about $400 million, which we anticipate that will get approved by the Commerce Commission in the near future, and that will be part of the work that Transpa will undertake over the coming 5 years out to about just before 2030. You'll see here on this capital expenditure forecast, while we've had a period of relatively low capital expenditure, that electrification and connecting up new renewable generation and increasing amount of electrical demand will give rise to an increasing capital profile for Transpower, and of course an increasing amount of debt funding for Transpower over the coming years. So finally, questions, and I apologise, I've run a little bit over time, but happy to take any questions at this stage, James, if you have any.
Yeah, no problem at all, Chris. Great presentation, and we've got plenty of people still logged in, so we can carry on at our leisure. No immediate questions from the audience, but I would encourage anyone who does see this subsequent to today, recording, whatever, you can still fire those through. Perhaps from me, a couple of things. I mean, there's lots of interesting stuff there. You mentioned about the balancing of supply and demand based upon the renewable generation. Why is that a particular challenge?
Well, of course, wind and solar generation aren't there all the time, but demand is there all the time. And New Zealand's relatively unusual in that most of our demand is, because we have moderate climate, comes in the early morning and the late evening, when of course it's not particularly sunny, and it may not always blow with wind. So that it's very important on managing the electrical system to have a stable base load of, which in New Zealand's case, we're relatively lucky that we have 56% of the generation capacity in New Zealand is hydro. We've got a relatively large base, but of course, managing for that wind and sun or solar, coming online and then dropping out and then replacing it with some base load, that's an increasing challenge for all electrical systems. And Adelaide or South Australia several years ago now, and Texas a couple of years before that, were good examples of managing renewable generation as an increasing challenge for system operators globally. But of course, there are ways and means of getting around that intermittency, which fortunately for New Zealand, shouldn't be such a task given the amount of hydro base load that we have on our system.
Okay, great. Yeah, I can certainly. That's very, very familiar. Our heat pump is always blasting on full power early in the morning. Second, well, I had a question around EVs, but I think you've answered in terms of. So it's interesting to see that increased demand based on those EV projections. Maybe a different question would be, perhaps for myself. Apologies, ignorant palm has only been a few years. You talked about the HVDC, so and there's some capacity upgrade there. Why is that such an important part of the infrastructure? Is that because of the most generation is in the south or the north, or why is that so critical?
Yes, primarily. Of course, the majority of the generation in New Zealand in the South Island, and probably a larger part of demand is in the North Island. So if you didn't have the HVDC link or the cables across Cook Strait, then you'd have very high prices of electricity in the North Island and very low in the South Island, which you do see from time to time if the HVDC link goes down for whatever reason, maintenance or a weather event or something else. So it's kind of like an economic asset for New Zealand, really. It just transports that relatively cheap and abundant hydro generation in the South Island through to the North Island. And so it's a relatively important economic asset here in New Zealand. It's not required, but of course it would lead to very high electrical prices in the North Island until more generation is built. And of course, kind of lower in the South Island where there's an excess supply over demand in the South Island there. So that's why it's such an important asset there. And high voltage direct current as opposed to high voltage alternating current is just a method of transmitting electricity with lower transmission losses. So that's why we have HVDC as opposed to HVAC.
Okay, interesting. Good to know. Thanks for that. I think we didn't have any other questions from the audience, so I think we'll conclude things there. So Chris, thank you very much for coming on this morning. Really great presentation, and enjoy the rest of your day. Thank you very much, Chris. And that concludes today's. Cheers, Chris. today's virtual investor event. We are back on the 6th of September, where we're going to hear from Meridian, Third Age Health, My Food Bag, and Heartland Group. Thanks to all our presenters this morning and to your audience. We'll see you again very soon in the near future. Bye-bye.